Alrighty. So today we're going to be talking about selling in the money covered call. So there's been some talk about this, whether in the money covered calls is actually a viable strategy. So is this a good strategy or is this simply just a bad mistake? So let's find it out together. So first of all, when we sell a covered call, right, generally we want to sell one that is above the current price with the objective of getting both intrinsic value and extrinsic value gains. So this is the cover call position. So basically you enter one when you enter into a shares position. So you buy 100 shares at the market and then you sell a cover call above the current price. So this way, when you sell the cover call, you'll be getting premium for this. So this is extrinsic value because you're selling out of the money. And then the intrinsic value gain will come if the stock actually goes above the cover call strike price at expiration. So this way your shares will be called away and then you'll be making the profit from the point of entry to where the cover call strike price is. So in this case, you have the double profits in terms of intrinsic value from this point to here and then extrinsic value from the cover call. Now, what about the in the money cover call? So the in the money cover call basically means that when you place the 100 shares, you immediately just sell a cover call that is below the current price of where you bought the 100 shares. Now, when you take a look at this, immediately it kind of don't really make sense, right? Because you are selling your cover call below your entry price, which means that your shares will get called away at a lower price than where you actually entered. So at first glance, you might think that, hey, I'm buying at 88.69, but then I'm going to sell it away at $85. Wouldn't that be a loss? Now, it does seem like a loss, but actually when you're selling this in the money cover call, it already have the intrinsic value factored for. So that means when you get, let's say for example, if you do get called away, right, at this price, you actually do not make any loss on the intrinsic value because the cover call, when you sell it, it would already have this intrinsic value from this point, 85, all the way to 88.69. So in this sense, you're actually not losing anything in terms of intrinsic value. So the only thing you're seeking to gain is the extrinsic value portion of this cover call. Now, depending on where you sell the in the money, of course, if you sell one that's extremely deep in the money, let's say somewhere here, then chances are there's very little extrinsic value and kind of make little sense to sell it here, right? So I kind of understand why some people might want to sell a cover call that's in the money around this price, because what they want to do is they're trying to capture the extrinsic value of this cover call only. They only want to make money on this extrinsic value in case, right, if the market, just goes somewhere, anywhere from this point to this point, right? Just anywhere this point, right? Excuse my drawings, but basically just this whole zone, anywhere above the cover call, that's what I'm trying to say. Okay, so let's try and investigate a little bit into this and see whether it is a good strategy or not. All right, so for this, let's simulate both the positions. So I'm going to simulate both the positions. So how it's going to work is that we're going to long 100 shares at the market, so it's at 88.69, and then we're going to sell one out of the money call at 92.5 for $2.14, and then we're going to sell the in the money call at 85 strike price for $6.18. So let's see which one is actually better, right? So if you take a look at the calls that I'm selling, this cover call, so first of all, let's take a look at the out the money call. So $2.14. So this is very straightforward. I chose these two strikes because they are pretty equidistant from each other from where the current strike price, or rather the current price of the stock is, right? So we have a kind of a rough gauge or measurement to see which is better depending on the different scenarios, whether the stock goes up or down. So based on this out of the money strike price, you can see that we're going to get $2.14 on the mark. So it's very straightforward. This is just all extrinsic value. Now, what about the in the money call, right? So this is where some people get confused, because if you sell an in the money cover call, wouldn't that mean that you actually are a loss? So I mentioned just now that it's actually covered in the intrinsic value. So if you were to see from $85 to 88.69, there's actually a $3.69 difference, right? This is the intrinsic value difference between the strike price of the cover call and where you long 100 shares. So if you take a look at the strike price of the 85 call, you'll notice that the intrinsic value is $3.69, right? It's just nice. This is the difference between these two strike prices. So you can see that if you were to sell this in the money call, you already take into account the intrinsic value that you would have lost if you get called away here, right? So you have lost $3.69 if you get called away at this strike price, but then by selling the covered call, you get back $3.69. So this is net zero. Mean to say there is no intrinsic value loss as long as it's above this covered call. Now the next thing is the extrinsic value. So you can see that the extrinsic value is roughly $2.50. So the goal of the in the money covered call strategy is to just simply get this extrinsic value down here. Alright, so let's take a look at the different scenarios. So the very first scenario is that if Starbucks is above $92.50, all right, so this is the chart of Starbucks. So if the stock goes above $92.50, what's going to happen? Well, first of all, for the out of the money call, the cover call is going to get exercised. Right, at expiration, if it's above the strike price, you're going to get exercised. So the profit is twofold, right? You have the profit from your cover call, which you sold, and you have the profit from your intrinsic value gain from where you bought it and where your shares are being called away. So the profit is, so this part is the intrinsic value gain. So from $92.50 minus off $88.69 plus the extrinsic value of your cover call, total you get $5.95, which is $595. All right, so now let's take a look at the in the money call option. So if you have the in the money cover call, same thing, as long as it's above your strike price, you're going to get exercised at this point of time, right? Your exercise price is actually down here. You're going to get exercised at $85 even though the price goes up here. So in this sense, you're going to be taking a loss, so to speak, on the intrinsic value of your shares difference from where the shares is and the strike price of this in the money cover call. But then you're going to add on to the value which you have gained from selling this in the money cover call, which is $6 and roughly 18 cents, $6.18 if you see this mark price down here. So if you notice, you actually make a profit of $2.49. So take a look at this, $249, and your extrinsic value is $2.49. So it's basically the same, right? So you notice all you're doing with an in the money cover call is that you're just trying to capture the extrinsic value of this option with a high chance of getting this extrinsic value, because for the shares, rather for the stock to be exercised compared this out of the money and cover call and this in the money cover call, is easier to get exercised on this in the money cover call than it is to get exercised on this out of the money cover call. So for scenario one, if the stock actually goes up, right, then it will be better that you sold the out of the money cover call, because you get the extrinsic value gain that is from this point of from this price all the way to here. For in the money cover call, you do not get this benefit. Alright, now let's take a look at scenario number 2. By the way, if this video has been helpful so far, I'd appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Alright, so let's take a look for the out of the money covered call. So if the price is somewhere in between these 2 points, it's actually below our out of the money covered call. So this means that our cover call, the out of money cover call, expired worthless, and the stock is either in a profit or a drawdown depending on where it is, right? So if it's above our entry price at this point of time, it could be quite ideal for those who actually do not want their stock to be called away, because your stock will be in a profit from this point to here. All right, you're seeing a slight profit. At the same time, your cover call expired worthless, so you also receive the premium from the cover call. Now, if the stock is actually below your entry price, so what will happen is that you will actually be in a slight drawdown, but then you still be able to get the full profits of your cover call. So we cannot really calculate the profit down here because you're not out of the position, right? You still have the 100 shares. So ultimately, this whole positions, whether you're up or down, really depends on whether the 100 shares go up in the end or it comes down, right? So for this, what we'll do is just calculate the premium which we receive. So the premium down here would be just $2.14. Right now, let's take a look at the in the money covered call. So for the in the money covered call, your cover call will be exercised because you are above this in the money cover call strike price, right? Anywhere above $85, you're going to get exercised, right? So what's the profit? So the same thing, the profit is actually exactly the same as scenario 1. There's no difference if you take a look at scenario 1, because you're just being exercised and all you're doing is just getting the extrinsic value gain. So in this case, if the market, alright, if Starbucks actually stays anywhere in between here, which is and above your in the money cover call, then it's actually better if you had sold the in the money cover call, right? Because you make more and you get out of the position. But then again, one thing you need to consider is your objective of actually getting into this position in the first place. Do you plan to hold this for the long term, or you plan to just capture only the extrinsic value down here, right? So if you plan to hold this for a long term, this could actually not necessarily be a bad thing compared to the in the money cover call, although you're making lesser here, because the stock may just be down here at expiration. But after expiration, the stock could just shoot back up, right? But if you have the in the money cover call, you're out of this position, so you do not get to make money on the intrinsic value gain of your 100 shares. Now, but on the other hand, the stock could actually also go all the way back down after expiration, right? So maybe for the in the money cover call, you could have already been exercised, you're out of the stock, no positions, then the stock starts to tank. So if the stock starts to tank, if you sold an in the money cover call, you would say, wow, you're very lucky because you already got out of the position. Now as the stock goes down, you do not have to sit in for this ride because you're already out of it. But those with these 100 shares, if you sort of out of the money cover call, the stock tanks, it's going to feel quite sucky, right? Because you're going to be seeing a bigger drawdown as the stock drops. Right, now let's take a look at scenario number 3, the last scenario, that is if the stock actually goes below the strike price of the in the money covered call. So which is better? Now the out of the money call. So the out of the money call, your covered call will be expired worthless and your stock is in a drawdown. So basically what I mentioned earlier, right? So your stock will be in a loss, you see in an open loss, and the only profit which you make, or rather the credit which you're going to receive, is rather just the covered call, right, which you sold $2.14. So basically that's about it. What about for the in the money covered call? Now the in the money covered call will also expire worthless because it went below your strike price. So in this case, it went below your strike price, and then you'll still be holding on to the stock as well. You still have 100 shares. The difference though is that you actually collected much more because you sold your cover call for $618. So this is almost 3 times what it is for the out of the money call. And in this case, your drawdown, because of your cost basis is going to be lower because you have this $618, your overall drawdown, your net drawdown, is not going to be as big as this out of the money call. So in this case, if the market actually goes down below the in the money covered call strike price, then you would actually be better off if you had sold the in the money covered call. So is the in the money covered call a viable strategy? So I've shared with you all the 3 scenarios and compare both of them side by side. So is this a viable strategy? Is this a good way for you to be, making money in the long term with an in the money covered call? So here's what I think. I think that the in the money covered call can be a viable strategy given the right situation and also given the objective you have when you actually get into this position. So for example, if you plan to buy 100 shares, right, to long 100 shares and then sell the in the money covered call at the same time, right, it will actually be cleaner to just sell an out the money put option, right? If you sell the put option that's out of money at the same strike price, it's actually synthetically the same position, right? If you take a look at this, this is the in the money covered call. You long the 100 shares and then you sell the covered call that's in the money, and then you sell an out the money put at the same strike price, right? So let's go back to this chart again. So instead of selling this in the money covered call, right, all you're doing, and you do not buy this 100 shares, all you're doing is just have to sell this put option at 85 strike price. And if you were to take a look at the put option at the 85 strike price, it's actually roughly the same premium that you will receive as this extrinsic value down here. Right, so there's really not much difference. So if you take a look at this risk profile, they're pretty much the same, right? Just only a few dollars difference. Okay, so the reason why you want to do a short put, selling an out of the money put option rather than go through the hassle of just buying 100 shares and then selling in the money covered call at the same time, is that there's actually much less buying power needed with the out the money put. right? You do not have to commit the capital to buy the 100 shares, all right? And then you just only have one leg as opposed to two. With the in the money covered call position, you need to buy 100 shares, you need to sell the covered call, so it gets quite clunky compared to if you just to sell one put option, and then you manage it so much easier, right? And for the put option, you can just keep rolling the put option down. So if the market goes below your strike price, you can just keep rolling again. You can roll it out or you can roll it down. Now with the covered call, it's going to get a little bit messy, and you don't want to really get through all the hassle, trying to figure out how to maintain this position as the stock drops, right? So if you plan to just sell an in the money covered call immediately after you have bought the 100 shares, then I would just suggest that you just sell the out of money put option, because it's pretty much the same. Now, if you don't mind exiting your stock position, then it could be viable, right? It would be a viable strategy to sell in the money covered call when the stock is overbought. So if the stock goes up, so this is assuming that you actually hold on to the stock as the stock goes up first before you sell the in the money covered call. So that means you buy the 100 shares here, all right? You hold on to it, and then let's say the stock comes down here, and then you bought the 100 shares, so you hold on to it. You do not sell the in the money covered call first. You wait for the stock to go up, so this way you actually are in profit on your stock. Then you sell this in the money covered call, right? In this case, you will be also making money in terms of the intrinsic value gain from where the stock price is to where the in the money covered call is, right? So this would make much more sense to me to sell the in the money covered call. So by this way, you actually secure your exit price at the current price if the stock stays above your in the money covered call. So this is where the current stock price is. If you sell the in the money covered call at this price, remember your covered call would have really compensated you for this intrinsic value loss if you were to be called away here. So basically, you're just securing this exit price already, right? Because your covered call intrinsic value would have already accounted for this. So all you're doing is that you're going to get the extrinsic value on this covered call. So that is why I say here, you also get the extrinsic value portion of the in the money covered call. So if the stock drops below the in the money covered call, you don't have a huge credit to offset the drop in the stock. So I actually have a chart down here for you to see what I mean. So for example, if you were to buy the stock down here, you hold on to it until the stock goes up down here, and at this point of time, you take a look at your stochastics, and then you see that the stochastics is overbought at this point of time. So at this point of time, when the stochastics is overbought, it doesn't mean that the market will come down immediately. There is a chance that the stock can still continue going up even though it is overbought, right? So this is just an indication. But when there is an indication of it being overbought, it just means that there is a higher probability that it could come down compared to it going up. So if you're afraid that the stock could start to come down and you do not mind getting out of the position and you want to secure this current price, on top of that, you also want to get the extrinsic value, right? This extrinsic value of $2.50 down here that comes together with this in the money covered call, then you can sell the in the money covered call, right? So this way, what you're actually hoping is, let me just remove the drawing. So what you're actually hoping when you're selling the in the money covered call is that the stock price would ideally stay above this covered call, right? So this way that you would be called away on your shares, and then you still be able to get this nice premium. At the same time, when you sell the in money covered call, again, you will still be essentially getting out at this current price of 88.69 because of the intrinsic value gain. And if the stock was to drop below your covered call, that means you do not get exercised and you still hold on to the shares, at least you still have a big compensation in this case, right? Because you're receiving quite a big of premium compared to if you were to sell the out of the money covered call, where you only receive $2.14, right? So if the market drops below your in the money covered call, we have already seen that it's actually better for you to have the huge premium you get from in the money covered call rather than selling the out of the money covered call. Now, if you're worried in the first place that it will continue to drop even more, and you don't want to wait all the way to expiration to see whether it will expire above your cover call, what you should do is that you can just sell away the stock outright, right? You can just sell at 88.69 without even selling any covered call. So this way, if the stock actually goes down after that, you don't have to worry, you should have sold it earlier on or what. So this is my take on the in the money covered call. So it can be viable given the right situation. But again, if you are selling the in the money covered call strategy at the point of time when you're actually buying the 100 shares, then I would suggest that you just sell the out of the money put option because it's exactly pretty much the same. Alright guys, so I hope this video has been helpful to you, and if it has, I would appreciate it if you give me a thumbs up and also subscribe to my channel. And as always, thank you for watching. I appreciate your time, and may the options favor you.